Welcome, everyone, to this explainer. Today, we're unpacking the mechanics behind something that literally touches every single aspect of our lives, the flow of money. We're calling this the pulse of capital, how money moves markets. Over the next few minutes, we're going to bypass the basics and dig directly into the active engine of modern finance. We're talking capital pooling, liquidity, and the true mechanics of interest. So, let's get right into it. Okay, let's dive into this with a quick thought experiment. How would you buy a new video game? If, say, you only had toy cars to trade. I mean, it sounds ridiculous, right? But this highlights a classic economic problem, known as the double coincidence of wants. Without a liquid medium to trade with, the friction of finding someone who has exactly what you want, and crucially, wants exactly what you have, well, it just grinds exchange to an absolute halt. That friction right there, that's the fundamental flaw of the barter system. It is wildly inefficient because it requires that direct matching of needs. But money? Money swoops in and completely solves this by acting as a universally accepted medium of exchange. It totally removes the friction, decoupling the act of buying from the act of selling. You just trade your value for a universally accepted token, and boom, it retains that purchasing power for future use. So what exactly is this tool? Well, money is really just anything widely accepted as a medium of exchange and a store of value. It doesn't actually have to be made of gold or silver. In fact, today, it's mostly just invisible digits on a screen. The secret ingredient isn't the physical material itself, it's the collective consensus of trust. As long as we all agree on its worth, fiat currency functions flawlessly to keep our markets nice and liquid. Which brings us to a highly practical question: where do we keep it? I mean, once we have this incredibly useful tool, what do we actually do with it? Stashing it under a mattress definitely doesn't help your capital grow, and it for sure doesn't fuel the broader economy. To truly understand the pulse of capital, we've got to follow where it goes and how it gets deployed. Now, what's really interesting about this concept is how it totally reframes our typical view of a bank. We so often think of banks as these static vaults just gathering dust. But in reality, a bank is a highly active financial hub. They're the vital interceptions that facilitate the entire flow of capital, acting as that critical intermediary that turns stagnant savings into active, highly productive market resources for the community. Let's actually map out the exact journey of that capital. Step 1, savers deposit their money. But it doesn't just sit idle. Step 2, the bank immediately pools that capital, aggregating all those individual deposits into one massive resource. And then, step 3, borrowers take out loans. The bank leverages that massive pool to finance things like mortgages, auto loans, and startup capital. This constant circulation of currency is what literally drives economic expansion. Your deposits are out there actively funding the market. But you might be thinking right now, hold on a second. If the bank is taking my deposits and lending them out to other people, what's in it for me? And that's a great question. Why should you let the bank leverage your hard-earned cash instead of just holding on to it yourself? Well, there has to be a powerful incentive to provide liquidity to the system and keep the economic engine running smoothly, right? And that incentive is interest. While we might sort of casually think of it as a little thank you payment from the bank, it's fundamentally the yield you earn for providing liquidity to the market. Because you're willing to defer your own spending and let this financial hub deploy your capital, you get compensated with a percentage return. Basically, your money goes to work for you, scaling your savings up over time. And this brilliantly illustrates the math in action. Think about it. If you save $100 at a 2% annual yield, the bank compensates you with $2 after 1 year. Now sure, $2 might not sound life-changing in a vacuum, but this is the fundamental baseline for compound interest. That is the exact mechanism that scales wealth exponentially over decades when you consistently deploy your capital. To understand the full pulse of capital, though, we really have to look at the dual nature of interest, because it cuts both ways. For savers, it's the reward, it's that yield you earn. But for borrowers, it is the cost of access to capital. When someone takes out a loan, they have to pay for that privilege. The bank essentially manages the spread between those two rates. It serves as the great balancing mechanism of the entire financial system, pricing both risk and reward. As we start to wrap up, I think it becomes entirely clear that money is far more than just coins or bills or a digital balance on your phone. It's a dynamic, almost living tool. It's the absolute lifeblood that powers both your personal financial growth and broader market innovation. Understanding how it moves really shifts your entire perspective from just, holding cash to strategically participating in the modern economy.
Ultimately, this tool accomplishes four absolutely crucial things. 1. It eliminates the friction of trade. 2. It preserves your stored value over time. 3. It provides a universal metric to compare wildly diverse assets. And 4, most importantly, it fuels economic growth by moving capital from where it just sits to where it's actually needed most. Banks and interest rates, they're simply the engines facilitating this whole flow.
Which brings us to a critical final question. Now that you know exactly how money moves markets, how will you put your capital to work? You understand now that banks are active engines and that interest is a seriously powerful mechanism for growth. This isn't just theory anymore. It empowers you to make strategic choices for your own financial future. So, what's your next move going to be? Think about it. Thank you so much for joining me for this explainer, and I'll see you next time.